All right. Hey, everyone. Investment Tuesday, recorded on Monday, May 12th. But we have big news. We have huge news coming out on the trade war, the tariff situation, and the market's ripping higher. Market's ripping higher. So, in this Investment Tuesday, I'm going to tell you my view, my take, my thoughts on the big news, which is this agreement between the United States and China that is sending markets surging higher. What it's doing to various different things, and some signals that most people are not going to pay attention to, but I think those are the things that are going to be quite important, especially as 2025 keeps rolling on. All right. And the other thing, which today now has suddenly moved off the center stage, is not a trade war, but an actual war, right? I mean, a war between two nuclear powers. Now, over the weekend, President Trump and the United States apparently brokered a ceasefire, but it's a ceasefire, right? I mean, between India and Pakistan, it's not permanent peace, it's a ceasefire. And it puts on center stage one of the big trends that is, very firmly in place for a particular type of technology, right? And that's what I'm going to cover in the second half of Investment Tuesday. First, I'm going to talk about a little bit about the trade deal, and then go through the what's going on in stock markets. We're going to talk about bond markets and crypto, and then I'm going to give you my take on things, and then also I'm going to show you something that probably most of you will disagree with, dislike, probably get trolled about how different players in the market are positioned very, very differently, and I'll give you my take on that, and then we'll talk about drones. As usual, we got to keep the lawyers fed, paid, and happy. So here we go. This video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, our view, our take of the world. You use it as information, use it as engagement, use it as entertainment, and have a good laugh. Why not? Right? All right. Next, all ATG Digital content may contain errors, oversights, mistakes. Yeah, you're not guaranteed perfection because it's in a YouTube video. Understand that investment operations, which means buying or selling a stock, buying or selling a option or a crypto token, have significant risks and can lead to the loss of your principal, which means you can lose money. We never have to cover the other side of making money because, of course, everyone's happy when that happens. And no one has a problem with that. Next, the owners, employees, contractors of ATG Digital own, trade, transact in the securities that are mentioned in this video and all of the content from ATG Digital. We do not take money from managements of companies or from crypto promoters or sponsors to recommend their stocks or crypto tokens. For better and for worse, for gain and for loss, you are getting our unique, independent, and our very, whatever it is, it's from us. You have to doubt it because we don't take any money from anybody. Even though we're offered money, we don't take it. We put out content pretty much daily. We've got the Substack. We've got the Ball Man Speculating podcast. And then we have YouTube, which I'm on. And then I got Dan and Dean that are also on. So, we're putting out a lot of stuff. I am on X pretty frequently. And then we post to Instagram and Facebook on a semi-regular basis. We have a business where we sell subscriptions, where we provide access to trades, and we have our subscriptions begin at $9.99 per month. That is for our silver tier, and then it goes up from there. So if you want to get a full sense of the ideas that I sort of like bring a little bit to in YouTube videos, go to atgdigital.media and check us out. Let's talk about what's going on. So during the weekend, there were these secret talks in Switzerland between the United States and China. And they've come up with a trade deal, which from my understanding, still early. I don't think like all the details are probably going to be perfectly right, but tariff rate for Chinese goods approximately is going to be 30% from on the US side. And on the Chinese side, it's going to be 10%. And markets are ripping higher. The NASDAQ 100 is up nearly 4%. The S&P 500 is 3%. And there is likely some level of jubilation, euphoria. Now, not to be like a wet blanket or anything on this, but the basic issue around tariffs, trade war, again, hasn't really changed, right? I mean, as it relates to markets, right? And that's not even, issues about the fact that this is for 90 days. It's not permanent. And it's with, again, while, a very important partner, we still don't have trade deals with Japan and the European Union or any of the other countries where, there's a whole host of issues that are there. So nonetheless, it is good news, if you will, if you were betting on, an event, right? I mean, there were a lot of people clearly who went short, meaning betting on prices to go down after Liberation Day in early April. And my view is that, with the surges that we've had since and today's surge, I'm guessing that most of those people are covering, meaning like, they are like, I gotta like get out of this. Either I'm losing money or else, my brokers are calling me and I got to cut these short. But when you look at this trade deal, and let's just assume it's going to last till the end of the year, right? What does it actually do? Well, it doesn't change the bottom line calculus of what happens to the vast majority of stocks that dominate the S&P 500, that dominate the NASDAQ 100, which is what? Globalization is still over. They cannot anymore do the labor arbitrage of simply shipping production to the cheapest place where you can make something. So that's still gone. It's not coming back. Second, you cannot wash your profits anymore through places like Ireland or the Cayman Islands or someplace like that to avoid US taxation. So that's still gone. You cannot arbitrage for environmental standards, labor standards to get, again, higher profits. That's still gone. So when this trade war began with Liberation Day, I said that, the biggest impact really is on profit margins. All right. I mean, tariffs for sure, some of it will be passed on to consumers. Truth is that we're very sensitive to prices. I mean, you lift the price of something up and you will see an immediate impact. Sales will go down. Sales will go down, right? For most things, right? Sales will go down. So a 30% increase for goods coming into the United States, while it's less than 145%, no one really was going to survive in a 145% tariff environment. 30%, let's just say the company is going to eat, the company on the buying side eats 10%, the company on the selling side eats 10%, and the consumers eat 10%. Sales are still going to go down, right? So a company that, is like, well, it's not, it's not the end of the world. It's still going to mean lower sales, and lower profit margins. So my point is that while this is being, I guess, represented to people as good news and the markets are ripping higher, yeah, someone has to like lay out, which is like in reality, nothing's really changed. A shift from where we were, which is globalization, World Trade Organization based trading rules, to trade deals one by one, tariffs, bilateral trade, which kind of like destroys the old world, like, is a enormous tax on profit margins. It's an enormous tax on profit margins, which are in 2024 are at record highs, and the big indices dominated by the big companies have these very high profit margins. And market prices reflect that. They do not reflect the world that has just been negotiated of 30% tariffs and of maybe higher tariffs into the future, different tariffs, the complexity of the supply chain, having to deal with all of this. That is not reflected in stock prices, in my judgment, in my opinion. There's other people who might disagree and think differently, but that's my viewpoint, which is that there is risk in the markets here. And I would not see this enormous surge as reflecting, hey, everything's good. Just go and buy willy-nilly, whatever you wish. No, I think that, the scenario is very much still of, yeah, this is going to be long-term a very different bull market. And this tariff deal, this trade deal, while, yeah, is good news in the sense that previously you had complete uncertainty, now you have some level of finality, which is like, okay, 30%, okay, we can kind of start to now begin to measure the level of pain on a company basis. And each company now is going to go and be like, well, how much of our supply chain is in China? Wow, okay, what prices can we lift? Where will customers be willing to pay more? How much can we squeeze the supplier for them to take more of the pain? Either way, all of those decisions are generally point to something where you're going to have less in sales because you're going to have to increase prices one way or the other. There's no way that the supplier, the maker, the producer is going to eat 30%. So they're going to lift prices by some amount. And then given that, all of those things, every company is going to be like, well, 30%, I think I'm going to begin to start to make plans, if I haven't already, to move production away from China, away from high tariff countries to someplace where it's cheaper. That costs money. And any place like that, well, it's going to be less profitable because otherwise they would be there already, right? I mean, they were in China because that was the cheapest place, the most efficient place to do it. So the profit margins are going to come down. So my point is that I don't believe too many people are going to provide you this context. And I would say this is really a moment where, for many of these companies, yeah, if they're being pushed higher at, and in the idea that, hey, everything's gone, all the risk associated with this over, I'm going to say no. I'm going to say this is still a new bull market. It's a bull market for something other than those globalization stocks that have done very, very well for the last, 5, 10, 15 years. And you want to be focused on the new bull markets, which today are taking a beating. Now, that's natural. They've just been ripping higher for the better part of a month. So, gold stocks are going down. Crypto is down a little bit. But nonetheless, if you go and look for the year, you can see that the buyer demand is there for the new bull markets. It's definitely there. And no bull market is like a straight line up. But that's where I'd be putting my money. which is like focusing on the new bull markets that are just getting going.
There's a new bull market in town, but it won't favor the timid or those smitten by old market darlings. No, this bull market is for the bold, those willing to ride new horses into the sunset. We would know. This ain't our first rodeo. To grab the bull market by the horns, get your Trade War Survival Guide available in the description of this video.
And where are the new bull markets? Well, we've laid out. I mean, I think it's very clear, especially now with the Bitcoin surge over 100K, that crypto is now in a bull market. Like Ethereum is ripping higher at 2,500. Precious metals, gold, silver in bull markets. There's a bull market in drones. There's a bull market in made in America things. There's a bull market in for-profit education stocks. Very particular places, genetics. This fits in very much with what I've been saying, which is that the new bull market is not in the S&P 500. It's not in the NASDAQ 100. It's in lots of little small segments that are seeing growth that benefit from the scenario that is unfolding higher. So that's my take on what is dominating the news, dominating the markets today. I don't think that this rally ultimately can be sustained, because as 2025 rolls out, all the things that I mentioned, in other words, you're going to have to start to model, forecast, anticipate, guide. Companies will start to give guidance for what they're expecting for the third quarter, for the fourth quarter. That'll start coming with the second quarter. So sometime in July, you're going to start to see companies start to say, well, now that we kind of know what the trade deal with China is, we're going to guide down revenues because we're going to have to increase prices. We're going to guide down margins because, we have to pay a tariff. That will not be received well by investors. I mean, there's just no two ways about it. I mean, the only way that would be received well is that if that bad news was completely priced in, and then you would have, markets move higher. In other words, it's where when markets have fully discounted bad news, then when the bad news come, there's actually generally like a relief rally, or even sometimes an actual buying rally. Because why? Well, the prices are so low, so cheap that people are like, yeah, we expected worse, so we're buying. But that's not the scenario we have today. I mean, stock prices are still within single digits of record highs. They anticipate record high profits, record high profit margins. This is not, in my judgment, in my opinion, a bull market for the S&P 500, for the NASDAQ 100, for the big tech stocks, all the stuff that people flooded into over the last 2, 3, 5 years. Yeah, my opinion, this is not a bull market for that. Where you want to go is to what I've been calling my secret bull market thesis, which just generally means, for the most part, most people just aren't talking about it, right? Nobody's really talking about electricity, which is an enormous, huge bull market, right? I mean, driven by the power needs of AI. And that is, that one leads to the next one, which is, what energy source can, is viable today in fairly quick time to put up new electricity plants? Well, it's natural gas. So all those areas are getting beaten up today, and that's where I would be a buyer. And if you want ideas on what to buy, then you go to ATG Digital, pick either the silver tier, pick the gold tier, pick the diamond tier. Those are our buy and hold stock tiers where you can look at our ideas, which are all in on the secret bull market, the select bull markets that are going on, and that's where I would look. Let me point to some anomalies, if you will, that to me tell me that you are going to see some unusual things. This is not 2020, when the markets ripped higher after the COVID crash. This is not 2022, when the Fed, in a shock move, despite inflation still being fairly high, decides to suddenly that they would going to start cutting rates. And here's why. Okay, so you can see here, these are all the major indices quote unquote the market, as people call it, which are all up in large amounts today. The big indices that most people track and follow are the S&P 500, which, in case you don't know, it's the 500 largest stocks that trade in the United States. NASDAQ, this is actually all the stocks that trade on the NASDAQ exchange. This is the New York Stock Exchange. And here's the NASDAQ 100, which is the 100 largest stocks that trade on the NASDAQ exchange. And you can see some big numbers higher, which is probably going to make most people think like, hey, it's all over. It's done. We can just go back to having a good time. I'm going to say no. I believe where you want to be buying today is really on the stocks that are getting hit. Yeah, that's where you want to be buying. All right. So what's the big anomaly that professional investors, like if I was running my hedge fund, I'd be like, wow, the market's ripping higher, but bond market yields are up. Well, let me not use fancy words like yield. It just means interest rates, right? So this is a bit of a surprise. Interest rates in response to this China-US deal, bond investors are like, not so good. Because if they were happy, and bond investors are happy when they think inflation is going to go down, not up. They, in response to the China-US deal, are like, we want higher rates. In other words, if you want us to buy bonds, you're going to have to lift rates higher. Now, that would be a little bit of a surprise to everybody. People would have imagined, now look, business as usual, trade deals struck. That must mean the Fed can cut. That must mean the 10-year interest rate will go down. Low interest rates, as now many people will at least tell you, even if they don't know why, are good for stock prices. But interest rates are going up inside, and not by small amounts. I mean, the 5-year yield, is well over 4%. The 10-year yield is at 4.45. The 30-year, I mean, these are big numbers that tell you that there is some dissonance here between what is going on in the stock market and what is going on in terms of expectations in the bond market. All right. And what happens in the bond market has a very large impact on valuations, on expectations in the medium to long term on the stock market. Generally speaking, when interest rates are low, that drives people into the stock market. Why? Well, I mean, just think from 2009 to 2021, when interest rates were really low, sometimes even negative. You just think like, well, why should I, save any money and leave in a savings account? I'm getting nothing. Heck, after I count fees, I'm actually being punished. It's a negative interest rate. So, why not buy, some stock, etc. However, if interest rates are going up, you think the reverse, which is that, why should I put money into some stock when I can get almost 4.5% from buying a 10-year bond? I mean, heck, if you look at 3-month treasury bills, which is that short-term yields number, you can get about 4.3% by buying treasury bills. No risk. Of course, inflation is a risk, but you can get 4.3%. Maybe I'll just keep a little bit more in cash. And you just multiply that out for big investors, medium-sized investors, small investors. It means less money coming into markets, which then translates to lower valuations, which then translates into smaller performance, because a lot of stock market performance is driven not by earnings growth, but by multiple expansion. In other words, the PE ratio goes from 7 to 10, 10 to 12, 12 to 15. As people gain more confidence, as people see other people making money, they all want in and they end up bidding the multiple higher. For growth stocks, it's based on the price to sales multiple, where it might go from 7 times sales, to 10 times sales, to 15 times sales, to 30 times sales, or even 40 times sales. But that is driven by, at least partly by low interest rates. And what you are seeing here today is that the bond market is giving a absolutely clear thumbs down signal. If you are in the camp of thinking that the old bull market is back, in other words, we're going to have low interest rates, there's going to be a lot of money that comes into the market and just bids everything higher, multiples will go higher, everything will be just, honey and roses. The bond market is saying no. It's clear, saying very clearly, it's saying no, because this is a big move. These are big moves, and the bond market is very important. And when the bond market and the stock market go in the other direction, is always a risk. It's always a risk, because you have to be like, well, who has sort of like the better information? And I will say, in my opinion, it is the bond market. Now, you will see here that gold prices have come off. They were, I believe, at the high. They were nearly, I think, 315, 320. So 3%. Yeah, I mean, after the run that they have had, a run of nearly 50% in 1 year, that's completely reasonable. That's profit taking. That is people maybe who, bought, a little bit late probably with some leverage, being liquidated out. However, it doesn't really change the underlying facts, which is that the bond market is signaling, hey, we think that inflation is going higher and interest rates are going higher. In that scenario, more people are going to want to store their value in gold. And certainly central banks around the world are definitely saying that they are buying gold. So on every level, central bank, institutional money, and even retail investors are buying gold. So this move, I don't think lasts very long. Maybe it lasts for a few weeks before we start to see lots of people step into these low prices and say, hey, yeah, sure, short term, yeah, this is not fun. But we can see very clearly that in a tariff bilateral trade world, we're going to have higher prices. We're likely going to have higher inflation. We're likely going to have higher interest rates. And most importantly for gold, we're going to have more money issuance by central banks, more spending likely by countries. And generally, we're going to see pretty much all fiat currencies. What's a fiat currency? In other words, what governments create around the world. They have no real backing. They're not backed by gold. They're not backed by a specific tax or some particular asset. They're just backed by the sort of like, a promise by the government that, that, hey, this can be used in as a medium of exchange. This can be used to pay your tax bill. I mean, that's the primary promise, really, that's there in any sovereign currency. That's the reason why people buy gold. In other words, which is like when you issue unlimited amounts of fiat currencies like dollars, like euros, like yen, like Swiss francs, like New Zealand dollar, like any of these currencies, people who are informed, they're like, yeah, I see what you're doing. You're issuing, this money like water. And we want something that has long-term value. And the same can be said as well for crypto. Now, if you were tracking prices yesterday, you would have seen that Bitcoin hit a high of about $105,000. And Bitcoin is even more sensitive to money issuance than gold. The reason for that is that because of its scarcity, finite and a trackable, monitorable, proven way, then you've got the halving that happens. So when you have that scarcity of finite plus, algorithmic halving hit, money issuance, even a small amount of money coming into Bitcoin moves it higher. And if money's moving into Bitcoin very quickly, money starts to sort of like funnel down into Ethereum, into XRP, into Solana, into Dogecoin, into all these very large into the large cryptocurrencies. And so today they're selling off, but nonetheless, they were 105,000. I mean, Bitcoin was 105,000 yesterday. And my best bet would be that this is very temporary and maybe it lasts a few days, maybe it lasts a week. However, the bond market is telling you that more money issuance is coming, which is why they're like, you need to give us higher interest rates if you want us to buy bonds. That is not bullish. That is not positive for S&P 500. That is not positive for NASDAQ 100 or the companies that dominate those indices. There is a huge divide between institutional investors and regular investors. All right. Regular investors, I mean, individual investors, retail investors, mom and pop investors. I'll just read some of this here, which is that, as shown below, smart money, which they call institutions, hedge funds, etc., is aggressively selling this market. And by they mean this market, they mean the S&P 500, means the NASDAQ 100. Those are the stocks that are dominated by the Mag 7 and other major companies. They're selling this market while individual investors, which they quote as AKA, also known as dumb money, are aggressively buying. The difference in opinions is stunning. Hedge funds and institutions are at near records for negative stock market outflows. In other words, not only are they selling, they are selling by the barrel. Right? I mean, they're like, take it, representing extreme bearishness. Meanwhile, individual investors, retail investors, are buying the dip at the highest rate since 2008. Who will be right this time? I'm going to say, given what I've pointed out to you, which is the bond market signaling that this deal, while positive, is not necessarily bullish for those big stocks. It's bullish for much smaller stocks, but the smaller stocks are de minimis amounts of the S&P 500, and they have almost no presence in the NASDAQ 100. So, whatever they do, is not going to change, the direction and trajectory of the S&P 500 or the NASDAQ 100. If you look at gold's performance in the last year, you look at Bitcoin's surge over the last week or so, and just a common sense analysis of like, hey, well, if globalization is no longer the model for these large companies and it is tariffs, and you start to now plug in 30% tariffs from China and maybe, or it's 10% for other countries, there is no scenario in which profit margins are higher. So profits one way or the other in 2025 and 2026 are going lower. And there's no scenario in which companies simply eat all of these tariffs and say, well, we won't pass these on in any way, shape, or form. They're going to increase prices in some way, shape, or form. And consumers' response is going to be, no consumer is going to be like, well, prices are going higher, so let me buy more. They're going to buy less. So you got two very large common sense negatives that are unfolding, and retail investors are buying, I'm guessing, purely based on price, in the sense that, like, well, NVIDIA was at 200, it's now at 100, that must make it cheap. Whatever, insert stock, look at price chart, this was high, this is cheap, let me buy, it must be certain to go back there. Yeah, I am not in that camp. And I am in the camp that I believe that institutions and hedge funds are going to end up turning out to be right. And I am doing this, then bringing this to you as a warning. I know that many of you likely maybe believe in this, are buying the dip. are there, and I would say, in my judgment, in my opinion, not a wise idea. Now, I'm not your financial advisor, I'm not your portfolio manager, and obviously I can be wrong, but nonetheless, my view is that the institutions are right. My best guess is that individual retail investors are wrong. And somewhere in 2025 and in early 2026, we will see all of this begin to take shape. Largely because, like I said, I mean, we'll start to get, now that we have some final numbers on trade, final meaning, 3 months, according to, what the Trump administration has talked about, we can start to plug in models, and you would not get higher profits. You certainly wouldn't get higher sales. And if you don't have higher profits and you don't have higher sales, and where expectations are very high, valuations are very high, that sets up things for disappointment. So, okay. So that's part one, which is about the announcement today, what's going on in markets, what my view is about this, which is I would not be a buyer of the S&P 500, NASDAQ 100, big stocks that people love and can write PhD theses on. Those are not the stocks to buy, in my opinion. I believe you want to be in with the bull markets, which I named earlier. And then let's now move on to the hot war, if you will, that is now going on between India and Pakistan. First drone war between nuclear-armed neighbors. So not enough that we have a trade war, not enough that we already have two wars, Russia, Ukraine, and then a much more complicated war that's going on in the Middle East between Israel, rebels in Yemen, which is really backed by Iran, and putting that whole area, essentially in a war scenario. We now have a hot war between India and Pakistan. Now, I am originally from India myself, so I have some familiarity with the feelings, the thinking that is driving this war. It's driven by the historical legacy that from the British that used to rule India, and India and Pakistan used to be one country. And upon independence, they split it up based on religion. Pakistan was set up as a Muslim country, and India was set up as a Hindu-dominated country. There are a lot of Muslims in India, but it is dominated by Hindus. And even at what was called partition, which was back in 1947, there was incredible violence between these two countries. They fought a war when I was a kid in 1971, and I can remember going to hide underneath the table with my mother and my sister. I remember my mom covering up the windows with newspaper, which is what we were told to do to make sure that lights didn't go through the window when there would be bombing raids, etc. Well, today we live in a different world. I mean, India and Pakistan are still using airplanes. However, it's much more of a drone war. This is really the point of difference between 1971 and now, whereas there, yes, planes were pretty important, and here planes are important, but what the drones can do are much, much more important. And that's been true as well in both the other wars that I cited, in the Russia-Ukraine war. And you'll see even on this headline, Ukraine says Russia fired barrage of drones and amid calls for ceasefire. Drones are like the sort of like the tip of the spear, if you will, for wars today. And it is something that has been building for a while. And it's one thing that I've been talking about. I'm saying that drones are in a bull market. Now, it may seem so small and so specific, but listen, we're not managing, $1 trillion, right? I mean, small companies are totally okay if you are a individual investor. But for sure, when I look at what is going on between India and Pakistan, Russia, Ukraine, in the Middle East, it makes me want to be long drones. We just, there are going to be more drones bought by more warring nations, factions, parties, whatever you want to call it, than planes. They obviously can be quite, low priced. They can be medium priced. They can also be quite expensive. Still, you can buy a lot more drones than even one big fighter jet. So much more sort of like affordable, and what they can do is much more versatile and flexible than a plane. I mean, drones can be used for local level surveillance. I mean, you can send a drone into like a building, into a neighborhood, go through a street. You can't really do that with a plane. Drones can, target with micro precision, where something is going to go. You can have it fly through a window, if you will. So it can be used for attack, used for defense, used for surveillance. And we just generally don't have enough drone companies, certainly not in the United States. The drone market, at least the consumer market, even in the United States, is dominated by a Chinese company called DJI. And it is a strategic threat, certainly to the United States, to have, their strategic competitor, China, be the primary supplier of this absolutely critical technology, which means that we're going to need more drone companies to start up. And the way that capitalism works is that if we start to see the stock prices of drone companies start to shoot higher, what's it going to do? Well, our friends on Wall Street will be like, hey, anyone want to start a drone company? Start one now, because you know what? In a year, 2 years, 3 years, we can sell you to the market at some enormous multiple. Start one up now, and capitalism will start to take care of the rest. In other words, drone companies will start up, kind of like the way, the AI. I mean, I was shocked to see that there are now in excess of 6,000 AI companies that have started in the last 2 years. So we're going to see a drone boom, and it's going to come in response to the current stocks in the market getting bid higher. All right. And that will be the catalyst. That will be the trigger for other folks to come in and be like, yeah, let's start a drone company. So one of the very few publicly traded drone companies in the United States is AeroVironment. Now they do some other things as well, and this is not a micro cap or nano cap. It's got a $4.7 billion market cap, and many people be like, "But Paul, it's $167. It's so expensive." Market capitalization, folks. It's not about the stock price. As I used to say when I was at Banyan Hill, listen, judging a company's size by its stock price is kind of like taking a pizza and cutting it up. If you cut it up into 4 pieces, they're very thick slices. If you cut it up into 20 pieces, they're thinner slices. It doesn't change the total value of the company. The total value of the company is one pizza. That's 4.6 billion. So if they made it cheaper, you might feel better by owning 100 shares. Nonetheless, the reason why it's 167 is because they just cut the pizza up into fewer slices. That's it, right? And then in terms of expensive or cheap or whatever, that's driven by valuation. You got to compare it to the amount of sales. You got to compare it to its profits. So the knee-jerk reaction from the vast majority of people when they see $100 prices, not for me, I can't make any money, that's too expensive. That's fine. You'll lose out. You can see the best performing stocks generally tend to be stocks that actually have higher stock prices. Why? Because the low price ones generally are junk. They're very low quality. In other words, you can accumulate hundreds of thousands of shares. You can accumulate 1 billion shares, but the likelihood of making money in those is very, very low. All right. So AeroVironment, they've been around for a while, and they are, at least in terms of the stock market, the biggest drone company that you can find. That really focused on drones. So my view is that you're going to see stocks, not just AeroVironment, but stocks like it start to do very well. Now, it hasn't really done a whole lot. You can see 1 year down about 40%, underperforming the S&P 500. However, I don't think that's going to last for very long. I mean, you can see, it really got smashed hard into the Liberation Day sell-off. However, yeah, it was at 236, and I don't know what the tariff rate is going to be for drones in particular, but I imagine that the Defense Department has a viewpoint on this, and that the Trump administration is likely to put a much higher rate on drones because we want to encourage local drones, local production of drones. We want them to develop in the United States. We want to build the expertise of knowing how to make these, knowing how to innovate on them, so that they have new capabilities. So my view is that drones, have all the elements that you want. In other words, drone companies in the stock market are scarce because, we allowed China to essentially just come and capture our market. They're valuable for lots of reasons. Drones, yes, they're being used in war, but they're used, in agriculture. They're used in engineering and architecture. This is a critical technology for any country, and it's critical that we have it. So they're valuable. And one thing that the war shows is that they're in demand. So I believe that, AeroVironment, other drone stocks, and we have, I believe, 3 different stocks spread across ATG Digital portfolios. You want to buy some of these because they're going to get bid up in 2025 and into any continuation of these wars. And I doubt that the India-Pakistan war, that ceasefire, lasts a very long time, just given the long history between these two countries. You will see stock market investors start to search out drone companies globally and go to bid them higher. All right. That is my Investment Tuesday. Recapping. Started with the big news of today, walked you through the markets, gave you my view of things, then pointed to another major event, which is a hot war between 2 nuclear powers, India and Pakistan, and how one of the secret bull markets sort of like gets put into the spotlight as a result of it, which is drones. And then, pointed you to a stock, which is, at least from my research, the most sort of accessible stock. It's $4.5 billion. Well, it doesn't have a low stock price. It has a low market capitalization. $4.5 billion in a world of, $3 trillion companies is pretty small. So that's Investment Tuesday. I hope you liked it. Thanks for watching. I'll be back next week. This is Paul saying thank you and